when they build in the 50 basis points into the illustration, into the ledger, that's what will allow you, that's what allows the illustration to look really positive. It's what makes it perform, even though the reality is it's not going to perform that way. And they actually basically tell you that later in this illustration. I'll show you there when we get there. Hey, what's going on, cash flow hackers? It's Chris with Life 180. And for this video, we're going to be talking about this policy right here, Flex Life 2 with National Life Group. It is an index universal life. It is actually one of the most popular sold index universal life products in the country. National Life Group happens to be the company that I used to be a director of business development with, and they are the #1 IUL company in the country as per sales of index universal life insurance. And so this is going to be a really fun example, I guess, a fun walkthrough for me, because I've never done a video going through National Life policy. Now, one of the things that I want to be totally transparent about is that this is an in-force illustration. So somebody sent me this illustration. They wanted me to take a look at this. I redacted all their private information, and I'm just going to go through this and use this as an example. Now, one of the things that I want to do here is I want to show, I'm going to just put myself in the bottom corner there, and we'll be able to see, and I want to share slide by slide what's going on in this illustration. So you can see here what's going on. They're paying $15,000 plus a month, a quarter. So it's just about $60,800 a year. It comes with accelerated benefit riders. If you die too soon, right? If you live too long, you're going to have income potential here. This is I'll get into the details of this, but I want you to see if you die too soon, live too long, or you become ill. So if you become critically, chronically, or terminally ill, you're going to have access. You can actually get critical injury protection as well, but you're going to get access to your death benefit while you're alive. It shows the living benefits of these policies. And honestly, the sales pitch of the living benefits, both for index universal life and whole life insurance, are both very good. And so here's where you can see I redacted some information, but at 5 years, he put about 300, it's actually 308 in premium. And you can see right here, the accumulated value is at 186 and the surrender value is at 159. So literally, after 5 years of contributing, this person is looking at, about 55% of their money is all they have, right? The surrender charges are $26,760 still, which are pretty significant. So even if you were to look at the accumulated value there of 186, it's still not performing. This thing is not, my guess is, and I didn't see the original illustration with this, but my guess is this is not performing the way that this individual thought that it would perform. And so let's go from here. Okay, so you could see here a couple assumptions. It's an option B, increasing death benefit during the accumulation years. This is just a summary over what we just talked about. Because this illustration is 30 pages long, I'm not going to spend a ton of time going through this page. If you want to pause it and read through this, you can. Ultimately, all this does is it breaks down the living benefits, how those benefits are paid out should you, have anything tragic happen to you while you're alive, right? And so you can actually take advantage of those benefits. Now, I've highlighted some stuff as I've gone through this. I'm gonna spend a little more time on the areas that I've highlighted preemptively here. So a surrender charge is assessed on the full surrender of a policy in the first 10 years from the date of issue or the date of an increase in the face amount. So this is saying this surrender will be slowly reduced over a 10-year period. The policy, as shown, is using the current illustrated rate will provide coverage for the lifetime of the insured based on the current interest rate and the current charges by the company. So I'm going to get into this in a little bit because this is showing that, okay, with current assumptions, this is saying you're going to have insurance forever. That's what that's saying. The policy shown using the alternative current illustrated rate will lapse in policy year 46 unless a higher premium is paid, right? This is based on the alternative current illustrated rates credited and the current charges by the company. So once again, I'm going to get into all this and it'll make sense on how the illustrated rates work, how the charges work, where all the different fees are, all these different things. Now, They throw this in here. It's a loan explanation, the different ways that loans can be used. There are 3 different types of loans, and the one that is most common that is being used in this instance is this participating variable loan rate. So you're charged a variable loan interest rate when, I went over it. When selected, all account value will remain in the various interest crediting strategies, and the loan values will continue to earn interest index credits as if no loan had been taken from the policy. So this is basically saying when you have your money in this, your account value is going to grow, that accumulated value or your surrender value that I showed right now in this policy, that let's just call it that 156, that $156,000. If they were to borrow against that, like let's say $100,000, they're going to pay a variable loan rate, and that money is going to grow based on whatever the index does regardless. Now there's going to be an expense for the loan interest rate at the same time. It's one of the dangerous parts that I think that is omitted by a lot of IUL agents is when you take a loan rate, they like to say like, hey, if you borrow at 4%, just for let's just say the rate is 4%, they like to say, well, man, if your index does 5.5%, then you're plus 1.5%. So you have plus 1.5% arbitrage, and they like to focus on that being the positive. And is that possible? The answer is yes, that is possible. However, what they don't talk about is when the market goes down, what happens is, because you have that 4% rate, now the loan that you have out there, you actually have that 4% rate loan, and your policy did 0. So what happens is this is an expense. This 4% gets added as an expense, and that can compound against you, because if these things, especially in retirement, if this starts working against you, the fees, the net amount at risk, and I'm going to get into that in the policy, can start to work against you. And understanding how the loan rates work are absolutely vital if you are going to be thinking about doing an index universal life, because they're sold on this long-term perspective, trying to get you to buy into the long-term vision on this, and to get you to look past the surrender cycles, right? All right, here we go. Please note, this illustration may reflect a non-guaranteed assumed interest rate that exceeds the illustrated loan rate. So this is a huge component. I'm going to read this again. This illustration may reflect a non-guaranteed assumed interest rate that exceeds the illustrated loan interest rate. So what does that mean? That means what I was just telling you right here. The loan rate is smaller than the crediting rate of 5%, right? So this loan credit, and what they do, and it's actually not 5.5%. It would be basically what they do. It doesn't even matter. These numbers don't matter. I'm just going to tell you what the numbers are. This is a regulation that's in place. They basically build in 50 bips, 50 basis points, which is 0.5%. When they build in the 50 basis points into the illustration, into the ledger, that's what will allow you, that's what allows the illustration to look really positive. It's what makes it perform, even though the reality is it's not going to perform that way. And they actually basically tell you that later in this illustration. I'll show you there when we get there. Once again, this is just, I'm not going to get in through all the details for the sake of brevity. This is just going through the accelerated benefits here. You want to spend time. If you want to pause and look at this, feel free. All right. And then here are some other breakdowns that we want to get through. Death benefit protection rider provides that the policy will not lapse in the first 25 years of the policy, even if the net cash surrender value is less than or equal to 0, provided that the premiums paid reduced by withdrawals, both accumulated with interest, less the policy loan balance, equals or exceeds the accumulation with interest of monthly guaranteed premiums. Now that is a tongue twister, but basically all this is doing is saying, if you do this, it's $885 monthly, $885. That's what this is costing you to be able to do this, to make sure your policy is not going to lapse in the first 25 years. That is a ripoff. I would not do that at all. Like, and that is an alternative rider. The agent got paid on that. It's a pretty significant payday just on that for the agent. So the insured must be at least 60. Okay, so lifetime. Okay, so this is a big one. This is a unique one. This is unique to National Life Group. Lifetime Income Benefit Rider, the LIBOR. Now, I was there when they created this, and it was when Flex Life 2 was created. This Flex Life 2 you can see here. It was Flex Life 1 before, and Flex Life 2, this was the hero of this product, was this idea of the Lifetime Income Benefit Rider. And it's what happened was they were having a lot of problems with illustrations. They were having a lot of challenges with people getting policies, and then they weren't performing. People were taking income from them, and then because the income, that was being borrowed against the policy, and then it was causing problems inside the policy, and then there was class action lawsuits and all these different things that were going on. And so they created this. They were like, hey, let's just create a thing that way when people start borrowing against this for income and retirement, we can guarantee lifetime income benefit rider. We're guaranteed that income will be there forever. I'm going to get into, when I get to the ledger, I'm going to break this down and show you kind of where the risks are in that and let you see the math behind it, because nothing in life is free, and if it seems too good to be true, it probably is. And because National Life is one of the only companies out of the 50 plus IUL companies in the country, the only companies that offers this lifetime income benefit rider. That's really important to understand. So here's some of the rules for it. The insured must be at least 60 years of age, but no greater than 85, right? And the policy must have been in force at least 10 years. So it's got to be out of the surrender period, or at least 10 years have passed since the last face amount increase, right? So if you've increased the face amount, which you can, that might push it down a little further. So you got to be at least 60 and under 85, and it's got to be at least 10 years since your last face amount increase or since the policy's been enforced, whichever is later. And any outstanding policy loans must be repaid in full before doing it. So if you've utilized this during your life for any reason, whether it was real estate investing or any kind of cash flow investing for your business, liquidity, anything of that nature, if you've done anything of that nature and you have outstanding policy loans, when you hit 65, let's say, and you want to retire, you're not even able to use this. Let's say you have $300,000 of outstanding policy loans before, because maybe you have it in real estate, you put it in your business, and you've just kind of been managing it. You got to pay those $300,000 of policy loans back before you can exercise this rider. So, and it only matters based on what your account value is when you hit 65 years old. In this instance, 60 plus, right, is the rule. And so once I get to the ledger, I'm going to go into more detailed more detailed description on that. Now, this is just simply showing it's the descriptor, the index kind of key terms and what's going on in the policy. So just read those if you want. All right, planned annual income. This is important. So this is going to go based on kind of what I was just talking about, the LIBOR. The annual amount of proceeds received from the policy at the end of the policy year. This amount is not reflective of policy values and must be read in conjunction with the guaranteed or non-guaranteed policy assumptions. This value may or may not be supported by the policy performance. So basically what this is saying is if you plan on taking income out of this thing, and once again, this is just the word description, the index of key descriptions. I just highlighted this one because it's important, but it's saying that this value that you see on this illustration may or may not be supported by the actual policy performance. And so it's important to understand. Everything here is all based on half-baked assumptions. That's really what it comes down to. This product is a life insurance product and does not represent an investment in the stock market. I know a lot of people think that by being in the index, you are participating in the stock market. I'm going to show you how nothing could be further from the truth. And what is actually creating your index performance in this. This product features a fixed crediting strategy, an index loan account, and 5 index crediting strategies. So there's all sorts of different options that we have to choose from, and I'm going to go through those when we get there. This policy features an index loan account, which uses the S&P 500 point-to-point crediting method with a focus on a cap rate. So the cap rates are key. Additionally, this product features 5 distinct, let's see here, I'm going to highlight so maybe this will make it easier. This product features 5 distinct indexing strategies. Index strategy 1, which uses the S&P point-to-point credit method with a focus on the cap rate. Index strategy 2, which uses an S&P 500 point-to-point crediting method, which focuses on participation rate. I'm going to show all this to you. And 3, which uses the S&P point-to-point crediting method with no earnings cap. So it's got a no cap option. Now, what I'm going to show you is that whether you use option 1, 2, 3, or the no cap, right? It doesn't matter. It's all smoke and mirrors, because the variables that lead to the success in all of these right here are going to be the same, because the inputs are the same no matter what. So therefore the outputs, the way that they work, are going to have to be the same. The index strategy 4, point to point. So I'm not going to read the rest of that. Each transfer, it basically says these are all annualized point to points, right? That's what this is going with. If you want to pause this and read it, I highlighted this because it's an important thing to understand how these different indexes work. So pause it, read it if you want to, and I'm going to move forward. All right. So this is kind of what I was just saying. This right here, these rates don't matter, right? So what they do is they say, well, we got to look back, and this is what causes our rates. The historical rates shown below are determined by applying the current cap, participation, and floor rates to the most recent 20 full calendar years of historical index performance. Now it says below, that's on the next page. I'll show it to you in a second. If no index value was published on the beginning and the end dates of the calendar year, then the most recent previous index value was used to determine the historical rate. The actual credited rates will vary based on actual change in the index and actual declared cap and participation rates within each indexing segment. So it's saying it's not just about the performance of the index. The cap and the participation rate will have a big impact, actually the biggest impact. These figures do not represent actual interest that would have been credited, because the cap rate and the participation rate would have changed over time and actual results would have been different. There are administrative costs, the administrative costs of insurance, and other charges associated with the FlexLife 2 IUL policy. The historical returns by strategy do not reflect these charges. So this is showing all of the results here don't include the charges for everything that they're talking about. So you got to back those charges out of it. Think about that. This is not meant to predict future performance. It is not possible to know in advance what actual crediting rate will be. All right, here we go. This is fun. But actually, before I do that, The historical rates do not reflect these charges. So this right here, when they say, oh yeah, this is a conservative rate, 5.64%, because look at the back testing and all that stuff, it doesn't reflect the current charges. Well, guess what? That average, you need to back out what the charges are, figure out what that is, and that's going to be your actual rate. And that's why Bobby Samuelson always says, you know, you're looking at 4.5%. If you can run these at 4.5%, you're going to be much more likely to actually be in the ballpark. And so what this is saying is that those charges and fees are about 1.04%, actually be 1.14% according to Bobby Samuelson, to get an expected, I guess, get this run in a way that would be in alignment with reality and what you should expect. And I'm a big believer, if it's what you expect, if it's where these things really get people running into problems, because they don't perform the way that people expect them to. And if you don't, that's where you have a problem. So, all right, so let's go to the next page. This is fun. All right, so, oh yeah, this is the hypothetical thing that I was saying. Now, you could see all these different indexing strategies right here, right? Hypothetical returns, these are all the index strategies. You could see here, let's go here. There's a no cap there. Here's caps here. There's a 8.5% cap with a 100% participation rate, 6.5% cap, 140% participation rate, no cap with a 40% participation rate, 8.75 cap with a 100% participation rate. It doesn't matter. Let me show you why. Okay. So here's the deal. This is how it works. Right now in this policy, I'm just going to use the numbers. I'm going to try to ballpark it. You got $150,000. Actually, no, I lie. I don't lie. I just didn't think through it completely. All right, we go here. 186,000. That's your accumulated value. I'm gonna make it accumulated value. I got to get my trusted calculator out because apparently I'm not that good at math. So 186 times 0.04. So what this is saying is that this money goes into the general fund, right? The life insurance company is in turn going to pull out, there's going to be able to say, hey, we know we can get a 4% because that's what our general fund is going to do. They then create your options budget. They know that that 4% on the $186,000 of accumulated value in your account is going to create $7,440 of return. What they do, and this is how when they say, what's the upside, what's the downside, right? Like upside potential, downside protection. Well, how does that work? They know that instead of just giving you this 4% and growing your account, they're saying, we're going to just use this amount that we could credit. Instead of crediting it to your account, we're going to go out and we're going to buy options with it. And so what does that mean? So they're going to take this 7,400. This is what they do this is what they use to create the options budget. So this options budget goes out, and so then what happens is they buy a call option. So they buy a call option, and if that option wins, then you're going to get up to whatever the cap is in this situation. So let's just say it's 8.75, right? So let's say the call option wins, you check, and it wins, you get 8.75 return, right? So that means you're going to get a crediting of 8.75% on the accumulated value of your account. So you get whatever that is, like, let's say 15,000 and change, right? That's how it would work. If it doesn't work and the call option fails and the market goes down, what happens is you lose this call option, and because you still have your money there, they risked your money in the call option. Your $186,000 is safe. So that's where you get the upside potential and the downside protection, because you're never really risking this money. You're only taking the guaranteed wins that you had, the guaranteed general fund performance. You're buying a call option, you're utilizing that call option, and you're putting it in there, and that's how they dictate what the cap rate is. Now, how do they dictate what the cap rate and the participation rate is? Now, I'm gonna erase this for a second. And what I want to show you is this is how it works. And this is really important to understand. So what happens is, if we know that the input, so what are we dealing with? We're dealing with the S&P 500 with all these different accounts, right? So we know that we're buying a call option. And we know that we have a general fund, right? These are the three variables, the three constants that we need to understand. So if we know that these are the three constants that we need to understand, we have all these different moving parts. We've got 8.75% cap rate with 100% participation rate, meaning if it did 8.75%, you're going to get 100% of it. 6.5% participation rate cap rate with 140% participation rate. That means if the market did 5%, you're going to get 140% of 5%. I know, this is like, it makes your head spin, right? And so what does that mean? If the market did 5%, that means you would get 140% of that, 5.7%, right? And so that's how that one works. If no cap with a 40% participation rate, well, it means if the market did 20%, you're going to get 40% of the 20%. So 8% will be credited to you. At the end of the day, all these, it's all smoke and mirrors. It doesn't really matter. Why? Because they're doing it with they're buying options of the same S&P 500 index, period. They're a call option. So what is the variable? They know it's going to be market performance is going to be the variable. Okay, that's fine. But what really has the biggest impact is the call options cost and the general fund performance. Because the general fund, this is the budget, And how much you can buy on that budget is based on the cost of the options. And this is the crazy part right now. Why during the greatest bull run have these policies not performed? If they give you upside potential, you're supposed to be participating in this in these indexes, in the S&P 500, which is the best, oldest, most stable long-term investing index in the world. If you can't bank on that, why the heck would you do this? And if they haven't performed during the greatest bull run, if these products associated with an index haven't performed during the greatest bull run of all time, why is that the case? It's because it doesn't matter what the index actually does. When you look at the performance, the growth rate here in this index right here, when you look at these numbers don't matter at all. These numbers right here don't matter at all because, once again, all the cap rates and the participation rates are completely variable. The insurance company has the ability to reduce your cap rate to 3%, reduce your par rate all the way down. I don't know what the number is on that one, but the bottom line is they can move these rates to whatever they want, however they want, and it doesn't matter what these numbers do on a good year or a whatever. The only thing that matters is how is the general fund doing and what is the cost of those options. Because and here's what I know, in a volatile market, the cost of options increases, and so if that's the case, even if interest rates go up and the general fund performs better, the market is more volatile, so the cost of options goes up. So even if the general fund goes to 5% and you have a bigger options budget, the cost of options is going to increase, so it's going to negate everything. It's one of the reasons Bobby Samuelson, I'm telling you, this guy's the best brain in this industry when it comes to understanding this stuff and really breaking it down. He says that even in the increasing environment, whole life insurance is going to do awesome, because with a whole life insurance product, you are participating in the success with the insurance company, because rather than having them use this 5% when the interest rates go up and the general fund performs better, rather than having them utilize that 5% to buy options, which are going to cost more in the volatile market, they're just crediting that to you. That's why I'm a big believer that over the next 10 years, whole life insurance is actually going to outperform index universal life. So that's really important to understand all this stuff. And so this is just, once again, I'm not gonna go through this. This is more of a graph, kind of charted breakdown of what I was talking about on the last slide here. And so you could see, all right, so actually this is good actually. It shows a guaranteed. So this shows right here, they can lower your cap rates as low as 3%. So right now, 8.75 to 6.5, and you can see the no cap and the 8%. They could lower those all the way down. Here are the participation rates. These are the variables that no matter what, they can reduce these however they want. So, okay, so guaranteed participation rates, you could see the 140 could be dropped to 110. The 40 on the no cap could be dropped to 25. The 80% no cap could be dropped to 30. At the end of the day, it doesn't matter. Why? Is because all of these at the end of the day are all going to perform basically the same, because of the fact that you're dealing with the same options budget, the same options cost, the same performance in the general fund. All the variables on the inputs are the same. So why the heck would they be the same or different on the backside when they're all dealing with the same S&P 500? The only one that's different is this one, the MSCI, because it's a different index. So it's going to have different potential, right? And so it's just important to understand that. So there you go. Let's move forward. So this is just for this specific policy, right? So this is just talking about the 10-year declining surrender charge, non-guaranteed assumed interest rates, right? So this is showing that this policy right now has a fixed term strategy. 33% of the money is in the fixed term, which right now I don't know what the index is, but this is just showing what the rate is. Illustrated rate, they're doing it 2.5%. The point-to-point strategy 1, it's got 34% in there, and then strategy 2, they're using 33%. So they basically have tried to be diversified in these, with these two products or two indexes chosen. They got a fixed term, which I don't think, if you wanted to have any money in a fixed term at 2.5%, just go put your money in a whole life policy that's going to control, you're going to get much better on a fixed side, the fixed side of the returns, and you're going to have more guarantees, and you're going to get a much, the insurance is going to be better. You're going to have better liquidity of your money, less surrender charges, all these different things. If you're going to put your money in an IUL, you want to have it in the indexes, which, in this situation, I would say you probably don't want to have it in here regardless. But, all right, let's take a look at this. And this is the ledger. This is the guaranteed illustration rate, right? So full transparency, I don't ever think we're ever going to have to worry about this. Like the guarantees in these illustrations, it's basically assuming DEFCON 5 in all financial situations forever, right? Every single year from here into perpetuity. And that's just not a realistic scenario. However, this is saying policy year 5, age 40, they've already paid their premium payment this year, going to 170, or they've got a accumulated value of 179. The surrender value, because they got the surrender charges, of 152. So that is what it looks like at the end of this year, based on the guaranteed column. That's only important because they've already paid 5 years. You can see at year 10, this is really atrocious on a guaranteed level. You only have $395,000 of cash value, even though they put $608,000 at that point in time in. So the fact that it doesn't get any better between here and here, really, as far as liquidity improving on a guaranteed basis this early in the policy, is a huge, huge, huge red flag to me. And so the other part on a guaranteed basis, I don't think this is an issue, but once again, I'm not going to make a big deal out of this because I don't think it's going to be a big deal. I don't think this is likely to happen, but you're talking about the policy lapsing at age 72 if you want to look at guarantees. Once again, if you look at a whole life policy on the guaranteed basis, this is going to go to 121 years old, no problem, right? And then it would just endow and you'd get paid it out. And so now what we're going to do is we're going to look at the current illustrated rate. And so now we have this, it's 186,000 is the accumulated value. Once again, the accumulated value, just to speak back in terms so you understand it, this is the option, but option budget is created based on this. So once again, so you'd take, actually I'm going to just erase this. So you'd take the 186,507 times general fund return, let's just call it 4% just for the sake of it, would be that it would create your options budget, and that is what it is, right? So that this 186 is what they're going to build the options budget off, and then they're going to back out surrender charges, and that's where you get that 159, right? And so now you can see right here you have premium payments going until you are 59, right down here. So 25 years of premium payments at $60,000 a year. This policy, as shown, look down here. This policy is shown, as shown using the alternative current illustrated rate, will lapse in policy year 46 unless a higher premium is paid. So this is only shown through year 24, but it's saying that this is based on the alternative current interest rate crediting and current charges by the company. So what is that saying? The alternative current illustrated rate. Now here's the deal. This is the column that I always say, listen, it's probably actually going to be a little bit less than this at the end of the day, depending on the company. Every company is a little bit different. But when we look at the performance of this policy, I'm going to go to the next page so we can see what it looks like a little further off into the future. We're looking at this column right here. Once again, the current illustrated rate, this is assuming everything's just going to go ahead hunky-dory, peachy, just the way, assuming everything is just perfect from here forward, right? This alternative illustrated rate is assuming basic assumptions, backing out all the expenses, backing it down to a little bit more of reality. And this is showing, let me get to the next one actually, because we got to get to here. This is showing that if you take income on this, you are out and is going to lapse by age 81. And you can see on this, I'm going to go back here, benefits and values are not guaranteed. Where did I highlighted that somewhere, but I'm going to read this right down here real quick. So benefits and values are not guaranteed. The assumptions on which they are based are subject to change by the insurer. subject to change by the insurer. That means the life insurance company can change your charges, they can change your fees, they can increase your cost of insurance, they can reduce the cap rates, they can reduce the participation rates, they can do everything to their benefit and your detriment at their will, and it's contractually built into the contract to make it so they're in control of this and you're not. And this is why when people go, Chris, why do you like whole life insurance and not IUL? It's because I never want to put my money into something that I don't control. When you put your money in here, you are not in control. The life insurance company is. And I think the laughable thing about this to me is everybody sells these as like a 401k alternative, like a rich man's Roth, right? And the funny thing to me, when you look at that, is the reason people don't want to be have their money in a 401k is because they don't want to be in business with the government. They put their money in a 401k and the government can control that money and kind of tax it away from them and do all these different things. And the reality is, you know, this is, you're basically just trading the government out for the insurance company, right? So here you go. The rates for the percent of premium expense charge, monthly cost of insurance, monthly expense charge, monthly policy fee, monthly percentage of accumulated value charge, and the rider charge, if any, will be determined by the company and may change from time to time based on expectations of future anticipated experience, end quote, right? So those are all areas that they can basically stick it to you. See page 16 for the guaranteed values, right? So I don't know what page this is, but on page 16 of the illustration is where all the guaranteed, it's all the guaranteed values, right? So that's the one I said don't worry about as far as D-Day, but the bottom line is the truth will lie somewhere in between all of those, right? Oh, actually, I want to go back to this real quick. So when we talked earlier about the LIBOR, the lifetime income benefit rider, that's this section right here. So they're showing you this $85,806 a year of income starting at age 60. This is all based on the assumption that you have this amount of money available when you hit retirement, when you hit that age to trigger it. If this account value is less than this when you hit 60 years old, if it's less, you will receive far less. And I guarantee you, this will be less. You're going to really fall more in alignment with probably, my guess is, and I don't have a crystal ball, so I guess I shouldn't speculate, but my guess is it's probably going to be a little less than that number. So this 85,000, listen, this is the problem. If you're banking on that, if you're utilizing that as a number that you're relying on for your financial planning, right? And then that number becomes 50K instead, and that's all you can pull at it on a guaranteed basis for the rest of your life. I don't know about you, but for most people, that's going to have a negative impact on what they're doing as far as their financial plan goes in retirement, right? So it's important to understand. And as you can see, like I said, you know, with the assumptions there, this lapses at 82, so you're not even able to make it work, right? Like it's gross, honestly. If you kept going with this and you use the lifetime income benefit rider, and you could do it, that revenue could keep going, but it won't be the 85,000. It'll be, let's say, the 50K number or some lesser number than the $85,000 is what it really comes down to, right? And so, not that, once again, not that it's a bad thing, but if you don't understand, this is where I highlighted it. If you don't understand how all these moving parts are working, the other part that I wanted to, well, if you don't understand them, then you can't make really informed decisions, right? And so the other thing I wanted to talk about is it's an option B increasing. So this is just basically going into a loan statement right here. It's showing the loan statement with the policy. So here's what I want to show. When we hit age 60, I guess it's on the previous page. When we hit age 60, right here, right there, this goes from an option B to A, which means it goes from being the increasing death benefit right here to a level death benefit, because now you could see that it starts shrinking. You start taking income, you stop funding the policy, you start taking this income, even though I don't think it'll be that much, but you do that. But what's gonna happen now, you see this accumulated loan amount. I'm gonna go to the next page, because now you could see here, you have to borrow the planned income is 85,000, 85, 85, 85, but look at the loan cost that goes with every single year if you don't manage it properly. And this is where these loan costs are also, this is the disgusting part about this. These loan costs are also assuming a guaranteed basis of positive arbitrage of 50 basis points, right? A guaranteed point of 50 basis points of positive arbitrage. The reality is if you have any negative years in any of these situations, let's face it, it's guaranteed that that's going to happen at some point in time if you live long enough for a year or two or three or four, right? We're gonna have flat years or down years or whatever, right? So we know that's gonna happen. So if that happens at all, this loan amount is based on never having that happen. In fact, having the opposite, having positive arbitrage. And so if any of that happens, this gets way worse because now you have that additional interest expense, not just on that year, but on the entire loan amount. So look at the accumulated loan amount. By the time you're 69 years old, you got $1 million in loans that you got to pay. So that 1 year, if the market goes down, you have an extra expense of $40,000 at 4%. $40,000 of loan expense that, by the way, is going to be taken out of this policy. It's going to be, they're going to take the money out of the policy. That's going to increase your net amount at risk, which is going to increase your insurance charges. And if this happens to you a couple years in retirement, this thing just implodes on people. That's why I say these things compound. The risk in the IUL policies compound the older they get, which is honestly, it's the opposite of the way that it should be, right? You're buying this. Yeah, you want the cash value from it. You want the living benefits. You want the cash access. But all Index Universal Life is, and I worked at National Life. They used to have one of the best whole life products in the world. Now their whole life product is garbage. And the reason they have their whole life product garbage is because they didn't want to sell it anymore. They wanted to sell this because it shifts the risk from them to you. And that's the way it goes. And so this is just showing, this is just showing if you were taking this 85,000, think about this. I'm just gonna let's make the numbers a little bigger. So in this situation, you got 4.8 million, okay? 4.8 million of accumulated loan value by the time you're 89, okay? So if in that year at 4.8 million, you have a 4% loan rate, let's check this out. 4,800,000, okay? Times 0.04. $192,000 of extra expenses if this policy doesn't perform, which will be taken out of your cash value. That is just the cost, the expenses of managing this loan are going to eat in over 10% of the cash value that you have. On top of all the other expenses, on top of the cost of insurance, on top of everything else. This is an absolute atrocity, in my opinion. And I think if everybody understood this about how IUL works, they would never get it. And so, or they would never buy it, I should say. Yeah, so this is just breaking down what your premium payments could be. This is just saying, hey, you could pay up to that. You're paying that. Minimum that you can pay is this every year. But if you do that, I promise you're going to have a problem. It's really kind of an inconsequential slide. Oh yeah, so here's where I was just showing you. This is kind of how it works. This is the expense breakdown. So I just showed you the cost, the impact of interest on managing the loans and how that can have really negative impact on your IUL in retirement. The crazy part here is the cost of insurance is also based on, you could see here the cost of insurance, and you could see all of the total expenses and deductions, this column right here. This is all based on certain assumptions. Now you can see the net amount at risk will start shifting. Here it shifts from option B increasing to option A, which is level. And so this cost of insurance column goes down. Now, if you have negative years in retirement, like I just said, that cost of insurance can go up and can get away from you. And you could see as you get older, those numbers are all based on this net amount at risk, which is a smaller number here, which is like 300,000, whatever. This column minus this column is the net amount at risk for the company. It's the cash value that you have, the death benefit minus the cash surrender value that you have. That is the net amount at risk. That is what this insurance charge cost is based on. And so it's important to understand. So anyway, that is the end of this illustration. I hope it makes sense. I know there's a lot of moving parts with this. it's important to read every single line. It's important to really understand what you're getting involved with when you buy one of these when you buy one of these products, or before you buy, hopefully, fingers crossed, before you buy one of these products, because it's one of the most misrepresented, missold, misunderstood product. And I don't think agents are selling it deceptively. I think they just don't know what they don't know. I think they truly want to help people in most situations, but they don't understand this. They haven't been in the business long enough to see the negative consequences. I've been in this, I've seen it, I've seen these companies, and this is the reason right here that I became so passionate, and why I left there and started selling whole life insurance and started coaching agents to understand how this stuff really works, because I believe in the power of what a properly designed whole life insurance product can do for people. I believe that properly designed life insurance product, whole life policy, should be a cornerstone foundational asset for every single person on the continent, on the face of the earth, if you're able to get one. However, you know, unfortunately, the industry has kind of like bastardized the whole life concept and brought it to the IUL, because the insurance companies, it pays more, it's more profitable, it gives the insurance company more control and mitigates their risk and puts the risk on you. And unfortunately, to me, that's not why you're buying a product like this. You're buying this for security, guarantees, opportunity, and control of your money. And that's not what you're getting here. So anyway, if you have any questions, go ahead and comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell. That way you're notified every time I launch a new video. If you're here still watching this, God bless you. It means you're committed to learning this stuff. This is a long video. It's not exactly the most sexy, fun content in the world. I get it. But if you wanna master this business, I honor you for taking the time to educate yourself and get through and understand all the nuances of these products. So anyway, till next time, have a blessed and inspirational day. We'll talk soon. See ya.